Howdy, Jacob here. Today's company in our dividend yield screener that we're looking at is Brookfield Infrastructure Partner Unit. Let's look at some of the numbers here. So, first, $12.5 billion market cap with an enterprise value of $48 million. So, a massive amount of net debt in this company. It's a multi-utilities company. They appear to make acquisition of utility infrastructure around the world. From a growth rate perspective, looks like massive growth. I presume a lot of that is through acquisitions. Their gross margin and their operating margins have almost converged. It's pretty interesting to see. Gross margin from mid 50s down to high 20s, and then operating margin from low 30s to mid 20s. Earnings per share, it looks like with all that revenue growth, did not equate to huge earnings spikes. It looks like their dividend has been paying out consistently higher than the earnings per share, probably reasoning out why they're issuing so much debt, which is the case. So a lot of times utilities companies are going to have a lot of plant and equipment costs that just to stay in business. That's not even to really grow the business. So it looks like so many acquisitions, 4.8 billion, 4.6 billion, 10.4 billion. Massive acquisitions. They're paying for it with their debt. Issued 950 mil, 1.4 billion, 3.9 billion, 3.9 billion. Yeah, they're just issuing debt to cover the acquisitions and the dividends. I don't know how long that can last. I mean, let's see, they went from 7 to 27 billion, but these higher interests coming in on 27 billion, an extra 1% would be absolutely huge. 270 million, an extra 3%, in interest rates. If they were to have locked in a low one of like 2%, now they have to do 4% payback. That 3% increase is going to be about $1 billion, and they really don't even make that in cash from operations. So I'm skeptical about that dividend. I don't see it increasing forever unless they just issue debt forever, which is going to further minimize their earnings from taking out interest expense payments. So this is crazy. So their highest net income was 2021 of 766. Their highest free cash flow, see 1.3 billion, and they're paying out 1.5 billion right now. So yeah, I feel like they'd have to pretty much they'd have to decrease this 90% a year to get down to 81 cents. I mean, even sounds way too high. I'd almost say they cut it in 3 and then can live off of 50 cent dividend, given how much they're making in earnings and cash flow. That sounds more reasonable. But then, that means you cut the yield in 3. We're looking at 1.92%, which is definitely just not the purpose of this stock screener. But we can finish with some assumptions. So again, looks like the revenue is growing a lot, but then with that, their margins are going down a little bit. So let's say they're able to grow 6% a year. Again, it's just through acquisitions, so there's no reason to inquire about a yield that's a terminal value that's greater than market average at this point. Again, they've been going down pretty consistently. We could say a 3%, 4%, Share change, nothing. Yeah, this is a company I really have to dig into to see what's going on with it, to understand these figures a little better. But when I just do a high level review of the company and look at how their dividend yield is, I just don't see it continuing forever. When you have to issue debt constantly on a consistent basis just to pay for some of these acquisitions they're doing, some of the debt that, or the dividends that they're paying out, I just don't see the longevity of it. So, all right, thank you, everybody. I hope you have a good rest of the day.